Gold doesn't usually fall like this. Not in a calm drift, not in a tidy correction, but in a sudden air pocket that feels like gravity switched on. And yet, in roughly 48 hours, the market watched gold drop almost $1,000 per ounce from its recent peak, with a brutal intraday slide of roughly 8% at the worst moment before the bounce arrived. That's not a normal move. That's the kind of move that shows up when leverage is stacked too high, when collateral is too thin, and when someone with size is being forced to turn metal exposure into cash exposure immediately. For years, the common story was that gold is the quiet corner of the financial world, a slow market, a steady market, a market that can't do what high beta tech stocks do. And then, in 2 trading days, it did exactly that. They said this kind of velocity could never happen in a market measured in tons and volt bars, not memes and momentum. They said gold is where chaos goes to die. But the tape just printed chaos anyway. Because sentiment does not change on a stopwatch. Liquidity does. And the institutions that live inside the plumbing of this market know the margin schedules, the risk limits, the settlement rules, and the collateral ladders. Before the public narrative even gets drafted, they know where the stress lines are because they built them. So if you're holding gold, watching gold, or even just trying to understand why the global system still treats a yellow metal like a financial instrument, pay attention. What I'm about to lay out isn't an opinion, it's a pattern. And once you see the pattern, the last 48 hours, stop looking random and start looking like a test. Welcome to Channel Name. This is where we decode what matters before it becomes a headline, where we track the numbers that actually move markets, and where we connect the dots between price, policy, and positioning. If you get value from calm, data-driven breakdowns like this, consider subscribing the way you'd keep listening to a wise elder who never raises their voice, and drop a comment with where you're watching from, because this market is global, and the signals show up differently depending on where you stand. Now, let's reconstruct what happened with forensic clarity. The speed of the drop is the first clue. Gold can trend down for weeks on changing rate expectations or shifting risk appetite, but a near $1,000 move in about 2 days is something else entirely. That's the signature of a market suddenly demanding more collateral from the people, who were using leverage to hold positions that looked safe until they weren't. When volatility spikes, clearinghouses and exchanges don't debate feelings. They change requirements. On February 2nd, week 26, COMEX gold margin requirements were raised. 8%, effective immediately into the most violent part of the move. If that sounds like a small tweak, translate it into behavior. For every futures position, more cash must be posted. Not next quarter, not after a committee meeting. Right now, that means anyone who is fully allocated to their trade has to find cash fast. And when cash is needed fast, positions get cut fast. What makes a margin change so powerful is that it doesn't target opinions, it targets balance sheets. A COMEX gold futures contract is commonly tied to 100 troy ounces. When price is near the thousands per ounce, each contract represents hundreds of thousands of dollars of exposure, controlled with a fraction of that amount in posted collateral. It's how futures markets allow hedgers and speculators to meet. But it also means small percentage changes in required collateral can create huge cash demands across a crowded trade. And it wasn't just one desk that had to answer that call. Producers hedge, refiners hedge, jewelers hedge, funds speculate, banks intermediate. Market makers quote two-way prices but manage inventory risk. When margin requirements rise, every one of those entities has to decide whether to allocate more cash to maintain positions or reduce positions to free cash. In a calm market, that decision can be gradual. In a market dropping hundreds of dollars per ounce, that decision becomes immediate. This is where the phrase forced selling stops being a metaphor. If a trader is down on a leveraged position, their equity shrinks as price falls. At the same time, the exchange demands more margin because volatility rose. Equity down, requirements up. That double squeeze is how positions get liquidated even when the trader still believes in the long-term thesis. Belief is not a line item on a margin statement. The timing matters too. Raising margins into a sharp move is like narrowing the doorway while a crowd is already trying to exit. It doesn't create the fire, but it accelerates the stampede. And because gold is used as collateral and as a liquidity source in multiple strategies, pressure in one corner can leak into others. A fund may sell gold not because gold is the problem, but because gold is the liquid asset that can be sold quickly to meet obligations elsewhere. That's why gold can fall during a crisis, even when the crisis makes gold conceptually attractive. So when you see an outsized drop over 48 hours, treat it as a diagnostic. The market is revealing where leverage was concentrated, and which participants were least able to post fresh collateral. At the same time, on the other side of the world, the Shanghai Gold Exchange tightened risk controls as well. 99 contract, the margin requirement was adjusted from 85,000 yuan per lot to 120,000 yuan per lot. Different venue, different currency, same message. Volatility is forcing the system to demand more collateral. This is where the central mystery enters. If the move were purely about demand collapsing, the physical market would soften in tandem. Premiums would fade, buying would pause. But the data has been showing a stubborn physical heartbeat, especially in Asia, where premiums can persist even when paper prices shake. In late January, Shanghai pricing was shown with a premium of roughly $167 per ounce over the global reference price, a spread that signals tightness or urgency in physical conditions. Two signals, opposite directions. To see why that matters, think about the bridge that normally connects paper to physical. Futures prices are supposed to track spot because arbitrage traders can buy one, sell the other, and deliver metal through the system if the spread becomes too wide. But arbitrage requires three things: access to financing, confidence in settlement, and the ability to source or deliver the underlying metal on schedule. And when volatility spikes and margins rise, financing tightens. When financing tightens, the spread that looked like free money starts looking like balance sheet risk, and fewer players step in to close it. In calm periods, that spread is a footnote. In stressed periods, it becomes the story. That can happen when local demand surges, when import constraints appear, or when participants prefer immediate settlement over paper promises. None of that requires a conspiracy. It requires only friction, and markets are full of friction once volatility wakes up. This is also why watchers sometimes talk about paper versus physical as if they are two species. They are linked, but the link is not magical. It is made of credit lines, shipping schedules, vault logistics, and rulebooks. When the link is strained, prices can temporarily diverge. That gap is the dislocation, and dislocations don't last, they resolve. The only question is how and who absorbs the pain when it happens. To understand why this moment feels like a test, zoom out. When markets are stable, leverage is invisible. It hides inside the confidence that tomorrow will look like yesterday. But when leverage is stressed, history repeats with almost embarrassing consistency. The playbook is old, it's just wearing new clothing. In 1980, gold's story became a lesson in extremes. A decade of inflation fears and geopolitical stress pushed prices into a blow-off, and then the reversal was vicious once policy tightened and the market's speculative heat cooled. The key detail isn't the drama, it's the mechanism. When volatility rises and financing becomes expensive, the market doesn't unwind gently, it snaps. In 2008, the world learned a different version of the same mechanism. During the financial crisis, gold fell sharply in the early phase, even though the narrative said it should rise. Why? Because the system needed dollars. Funds sold what they could, not what they wanted. Gold, being liquid, became a source of cash. Then, after the forced selling wave passed, gold resumed its role as a hedge in the next leg of the crisis. First the margin call, then the meaning. In 2011, gold also offered a reminder that even powerful trends can stumble when the macro narrative shifts. A long run higher met a changing policy backdrop, volatility jumped, and the metal went through a grinding reset that punished anyone who believed price could only move in one direction. The playbook wasn't mysterious. Crowded positioning met a change in the cost of carrying that positioning. In March of 2020, another parallel appeared in real time. When the world froze, markets sold what they could to raise cash, and gold dipped during the first wave of liquidation, even as fear was rising everywhere else. Then, as liquidity conditions improved and policy responses expanded, gold found its footing and pushed to new highs later. The sequence was the lesson. First, the scramble for collateral, then the return to narrative. In 2013, another parallel. A sharp, sudden drop that shocked holders who believed the metal could only move slowly. Behind it were positioning shifts, liquidations, and a sudden change in confidence about the path of policy. The lesson, again, was not about feelings. It was about structure. When the market is crowded and the exits are narrow, prices can gap in a way that feels personal. Now in 2026, the structure is flashing. Not because gold is irrelevant, but because it has become too relevant to too many portfolios at the same time. The numbers tell that story. In 2025, total gold demand, including over-the-counter activity, exceeded 5,000 tons for the first time, with an estimated value around $555 billion. And during that year, gold printed 53 new all-time highs. That's not a sleepy market. That's a market that has been trending with conviction, attracting more capital, more attention, and inevitably more leverage. When a market sets dozens of record highs, it attracts not only long-term holders, but also fast money that borrows to amplify moves. That's not a moral judgment. That's a description of how modern markets function. Futures exist to transfer risk, options exist to shape it, financing exists to magnify it, and then, at the worst moment, margin exists to control it. So who is positioning and how does the system reveal it? Start with the clearinghouse. Exchanges like COMEX don't move margins to make headlines. They move margins to manage default risk. Their job is not to predict price. Their job is to make sure that if price moves violently, the system still settles. When they raise margin requirements in the middle of turbulence, It's an admission that volatility has exceeded what their previous assumptions priced in. Now connect that to the traders who have to respond. Large commodity funds, managed futures strategies, and leveraged macro players often run risk models that target a level of volatility. If volatility rises, they reduce exposure. That selling is mechanical. It cares about the risk budget. Combine that with higher margins and you have a perfect storm. Less exposure allowed, more cash demanded. The same position becomes too big twice from two directions. Meanwhile, banks that clear trades and provide financing tighten their own internal limits. Prime brokers look at the same tape you do, and they decide what they'll accept as collateral and at what haircut. In a volatile metal, haircuts rise. If a trader's portfolio is marked down, collateral becomes insufficient. That's when calls go out. The timing of those calls creates coordination without anyone needing to coordinate. If multiple desks are hit at the same time, they sell at the same time. If multiple funds use similar volatility targets, they de-risk at the same time. If multiple venues raise margins, they demand cash at the same time. It looks like a unified movement because the system's rules push everyone in the same direction at once. This is why the test feels personal to gold holders. It's not a debate about the value of gold. It's a demand for collateral. The market is essentially asking, can you hold through a volatility spike without being forced to sell? Now bring in the second layer, the east-west split. Paper gold is dominated by futures and derivatives, where exposure can be created and liquidated quickly. Physical gold moves in bars, settlement cycles, shipping, refining, and vaulting. Those are slower processes. When paper gets hit by forced liquidation, physical can remain steady if real demand is present. The result is a premium in the physical heavy hubs and a discount in the paper heavy venues. That's the dislocation. If Shanghai is showing a premium while Western futures are plunging, it suggests that the demand for immediate, deliverable metal has not vanished. It suggests that what vanished was risk appetite for leveraged exposure. That distinction matters because it changes what the drop actually represents. It may not be a vote against gold. It may be a liquidation event. Here's where it gets interesting. A liquidation event creates its own feedback loop. Prices fall, volatility rises. Volatility triggers margin hikes and de-risking. De-risking creates more selling. More selling pushes prices lower. That cycle can be self-reinforcing until enough positions have been washed out and enough collateral has been rebuilt. Only then can the market return to trading on fundamentals like demand, rates, and currency flows. The question then is whether the physical market's premium is a stabilizer or a warning flare. If physical premiums persist while paper collapses, it can mean that a rebound becomes violent once forced selling ends, because paper prices have to catch up to physical tightness. But it can also mean the system is splitting into two tracks, and the mechanism that links them is under strain. So let's talk about the mechanism in plain language. Imagine a crowded theater where most people are sitting calmly. They bought tickets because the show is popular. But a few people bought their tickets on credit, assuming they could pay it off later because the show would stay popular. Now a security announcement says everyone who bought on credit needs to pay a bigger deposit immediately or leave. Those people stand up all at once, trying to exit. Their movement causes others to stand up, not because they want to leave, but because the aisle suddenly fills. The panic isn't about the show, it's about the exit. That's margin in a leveraged market. A move from 6% to 8% margin means the same position requires about 1/3 more collateral. For someone running a large book, that's not a rounding error. That's a cash event. If cash isn't available, the position is reduced. Reducing positions means selling contracts. Selling contracts pushes price down. Price down means more accounts breach limits. Limits trigger more selling. The system doesn't care who started it. It cares that it ends without defaults. Now layer in the Shanghai change. Moving from 85,000 yuan to 120,000 yuan per lot is a sharp increase. That forces participants there to either post more funds or reduce exposure. When multiple venues tighten at once, the global pool of speculative liquidity shrinks. This is why it's fair to say gold holders are being tested, not by the metal's value, but by the market's financing conditions. Now, zoom back to the evidence that makes this moment unusual. Gold demand surpassing 5,000 tons in 2025 is not a trivial statistic. 5,000 tons is 5 million kilograms. It's a physical reality, not a chart pattern. And at an estimated value of about $555 billion, it's a financial reality with the scale of a major global asset class. When demand runs that hot, the market becomes crowded. Crowds can be stable for a long time, but when they move fast. 53 all-time highs in a single year is another clue. That kind of relentless upward pressure can lure strategies that treat gold like a trend to be ridden. Trend strategies work until they don't. And when they unwind, they sell because the trend broke, not because they suddenly decided gold is worthless. Now consider the premium data. A premium of roughly $160 per ounce in a major physical hub is a sign that someone is willing to pay extra to secure metal there. Premiums can reflect taxes, capital controls, demand surges, or local liquidity.